Well, for many of us trying to save for the future, all the account names, IRAs, Roth IRAs, trusts, non-qualified accounts can start to blend together. What's what makes sense for you and your family? Well, this morning, financial advisor John Donez is here to help us sort it all out, explain the difference of each account. Because, John, it's really one of these things that you don't know these things until you have to know these things. So how do you guide people?
Yeah, so I mean, the main start is to just see what you have, right? Bring in your statements, bring in your 1040s. Let's see how much you make, where you put it, and what the best situation is for you long term.
Talk about when people have a 401k. They're used to that terminology, right? People are very familiar with the 401k.
Yes.
But how do you expand beyond that if it's in your best interest?
Yeah, so that's how most people save up for their retirement, is whatever is given to their employer, 401k, 403b, different things like that. But there's actually different things that you can do for yourself. You can open up a traditional IRA for yourself, a Roth IRA, and possibly move that traditional money that you're going to have to pay taxes on later into a Roth through Roth conversions. And you can also set up individual trust or joint accounts, which are non-qualified accounts outside of retirement that you can use for, so the taxable gains on those will be done on capital gains tax, not on taxable income. So that gives you a little bit more of a flexibility from a taxable perspective.
And so when do you see people glazing over when you explain this stuff, and how do you simplify it for them the most?
It can be difficult because some people haven't ever had this kind of talk through them. You know, financial literacy is one of those things that we kind of make sure that people know and understand, because you've worked so hard 25, 30, 45 years and you haven't thought about it. You've just had that deducted out of your income just
over and over again.
And then you finally get this huge lump sum payment and you don't really know what to do with it. And that's the main first goal, is what we try to do, is see where your assets are and what we can really do to help you.
So what is something, if you still have 20 years of work left in your future, what is something you need to start doing now so that you can maximize what you save for later and also not be too heavily taxed?
See specifically what your 401k money is going into, I think, is the first step, because a lot of employers now are offering Roth IRA options in addition to the traditional IRA options.
Difference? Tell people that.
So traditional IRAs that'll be deducted from your taxable income, so you're not going to pay taxes on those, but whenever you withdraw them, you do get taxed on that down the line. Roth IRA is the exact opposite, where you pay taxes on it now, but it grows tax-free for you.
Okay, see, that alone is such a graspable way of seeing it, and then you can kind of grow from there.
Exactly, exactly.
Awesome. John Donez, thank you so much. Very helpful.
Of course, thank you for having me.
Absolutely. All right, guys.